Welcome to Stocksees. Today, we will start a new video section that will concern the strategy and history of the most important successful investors and entrepreneurs. We will start with John Templeton, who had the motto, buying when everyone is afraid, selling when everyone is optimistic. Stay tuned until the end of the video to understand his successful strategy in investing in maximum pessimism. Let's get started. Sir John Marks Templeton was one of the most influential and pioneering investors of the 20th century. He is considered by many to be the father of global value investing and the man who taught Wall Street to look beyond America's borders at a time when such a thing was considered almost unthinkable. His approach was not simply technical, it was philosophical. It was based on values, discipline, and spiritual quest. He was born in 1912 in the small village of Winchester, Tennessee, and died on July 8, 2008, at the age of 95. From an early age, he grew up in an environment where strict discipline was combined with great freedom to experiment. His parents believed in responsibility and autonomy. They allowed him to do things that today would seem outrageous: buy dynamite, build makeshift machines, experiment in laboratories that he built himself. All this gave him two characteristics that he kept throughout his life: independent thinking and the courage to explore the unknown. He studied at Yale, where he distinguished himself for his academic excellence, and then as a Rhodes Scholar at Oxford. There he combined philosophical study with economic studies and developed an interdisciplinary perspective that would profoundly influence his future investment decisions. Templeton's philosophy was not simply economic. It was a profound approach to life, value, faith, and science. In 1939, during a time of global uncertainty, before World War II even began, Templeton made his first major investment that became historic. With a $10,000 loan, he bought 100 shares of every Wall Street company trading below $1. There were 104 companies in total, of which 37 were bankrupt. Although risky, this experiment proved something important. Great opportunities appear where everyone else sees only fear and failure. Templeton was not afraid of uncertainty, he exploited it. After the war, many of these companies recovered and his investment yielded huge profits. Since then, the phrase "buy at the peak of pessimism" has become a trademark of his philosophy. In 1954, Templeton founded the Templeton Growth Fund, implementing a pioneering international strategy. At a time when most American investors were limited to domestic markets, Templeton looked beyond borders. He began investing in European and Asian companies, often in countries considered risky or emerging. In the 1960s, he was among the first investors to buy Japanese stocks, such as Toyota and Sony, as the country struggled to recover from World War II. This global diversification was fundamental to his strategy. Templeton's investment strategy can be described through four main pillars. 1. Unconventional investing. The rule of maximum pessimism. Templeton was the ultimate contrarian. His central idea was that the best investments are made when everyone else is afraid. First example, 1960s, Japan. While most Americans ignored the ruined Japanese companies, Templeton bought stocks of high-growth industries at outrageous prices. When Japan's economy recovered, his returns were enormous. Second example, South Korea, 1970 to 1980. He bought companies like Samsung and Hyundai when prices were extremely low due to political and economic instability. This choice yielded excellent profits during the country's development. 2. Value investing, buying value, not fashion. Templeton was a strict value investor. He did not follow fashions or technological trends. He bought companies with low PE ratio, stable cash flow, strong management, undervalued value in relation to future growth. Example: Russia, 1998. When Russia went bankrupt, most investors avoided the country. Templeton bought energy and industrial companies at very low prices, taking advantage of the devaluation. In the following years, the investments yielded multiple profits. 3. Global diversification. For Templeton, the world was a vast investment field. Investors should look beyond their domestic markets to reduce risk and identify undervalued opportunities. Example: dot-com bubble 2000. While the US markets were in euphoria, Templeton preferred to invest in emerging markets in Latin America and Asia. When the bubble burst, his clients had protection and higher returns. 4. Discipline, patience, and time perspective. Success was not a matter of luck. Templeton insisted on discipline and patience. He held stocks for decades, allowing the market to recognize their true value. Templeton's saying, "Bull markets are born in pessimism, grow in doubt, mature in optimism, and die in euphoria." Let's now look at some examples of the strategy's application. Argentina, 1989. In 1989, Argentina was experiencing hyperinflation and a political crisis. The markets had collapsed. At that moment, Templeton saw an opportunity with low-value markets that then exploded. Russia, 1998. In 1998, Russia went bankrupt. Most investors moved away, but Templeton bought energy and industrial companies at very low prices. Japan, 1960. After World War II, most Japanese companies were undervalued. Templeton bought early, seeing the country's growth potential, resulting in large profits in the following decades. Dot-com bubble 2000. In 2000, the US technology market had reached a bubble. Templeton avoided overvalued stocks and turned to undervalued international markets. Templeton did not consider investment as a means of enrichment alone. Spiritual development and humanitarian contribution were equally important. He founded the John Templeton Foundation in 1987 for research into the relationship between science and religion, and the Templeton Prize in 1972 for individuals who promote spiritual progress. He believed that financial success and spiritual cultivation should coexist. His fortune at the time of his death in 2008 was estimated at approximately $4 billion. The majority of this fortune came from the Templeton Growth Fund and his investments in international markets. A significant part of his fortune was transferred to the John Templeton Foundation. John Templeton taught not only investment techniques, but a whole way of thinking about approaching the markets and life. His key lessons are as follows. 1. Buy when others are afraid. The central message of his strategy was that the best opportunities appear when the markets are in crisis and most investors are panicking. Important element: fear creates devaluations in stocks, which can offer high returns when the market recovers. Example: Japan, 1960s. Most stocks were cheap due to the devastation of the war. Templeton bought early, and the investments yielded huge profits when the economy grew. 2. Sell when others are celebrating. If the market has reached an overly optimistic point, prices are overvalued. Templeton argued that this is the time to sell some or all of the investment, his saying, "Bulling markets die in euphoria." Example, dot-com bubble 2000. While most investors invested in overvalued technology stocks, Templeton preferred to reduce his exposure to the US market and turn to international undervalued markets. Third, thinking globally. Global diversification was a central principle of Templeton. He was not limited to the domestic market, but looked for opportunities around the world. Important element: diversification reduces risk and opens doors to markets that have no copies of the bubble or crisis. Example, Russia, 1998. Buying energy companies after bankruptcy, resulting in high returns as the economy stabilized. Fourth, challenge the crowd. Templeton believed that investors often make mistakes by following the crowd. On the contrary, independent thinking and research create an advantage. Key point: markets are emotional. The crowd panics or celebrates without logic. South Korea example: investing in markets that were considered risky, such as buying Samsung and Hyundai at very low prices, resulting in extraordinary profits over time. 5. Long-term horizon. Patience is necessary to see the profits realized. Templeton held stocks for decades if he believed in their fundamental value. Key takeaway: the market takes time to recognize the true value of an investment. Example: his early investment moves in South Korea and Japan only paid off after years of economic growth. Sixth, continuous study and humility. Templeton believed that investors should remain lifelong learners. Humility towards the market and continuous research are critical elements of success. Key takeaway: learn from your mistakes and don't repeat the same pitfalls. His saying, "The less we know, the more eager we are to learn." John Templeton was not just an investor. He was a philosopher, a pioneer, and a humanitarian. His legacy lives on through the funds, institutions, and investment rules he created. His story teaches us that true success comes from a combination of knowledge, courage, discipline, and a deep understanding of human nature. Templeton's life and strategy is a guide for any investor who wants to think beyond the crowd, invest wisely, and create wealth with meaning. If you enjoyed the analysis of John Templeton's history and strategy, like the video, subscribe to our channel, and click the bell to be notified of our new videos.